So, should we buy or sell the Stanley Black Decker stock? First off, read this disclaimer carefully. Then do your good deed of the day by liking and subscribing. So, I have this theme here. Stanley Black Decker is in the bottom, and yeah, I just call it Handyman. 3% from the 52-week low, minus 60% away from the highs. Here is their website. Yeah, they make a lot of tools. So yeah, they do have a pretty broad portfolio. And they have a very strong brand in this space. Okay, so let's look at the charts, weekly data points. We have seen a very substantial sell-off. You could make the case that this potentially could function as a support level. These are lows back here. And also you have a cluster of support levels back here between 2011 and 2013. When I see a chart like this, I'm not really enticed to put on a short position because there already has been a very substantial sell-off. Could it go lower? Sure. Was it the best time to put on a short position back in early 2021? Yes. Just was. Similar to how it was good to become bullish when things looked very bad in 2020. And we have lost all the gains since 2020. Begging the question, were all of the bullish theses leading up until early 2021, were they all just incorrect? Or maybe the truth is in the middle. If the truth is somewhere in the middle, then playing with percentages, we could, talk about some significant upside. Let's look at the daily data points. Obviously, this is bearish. There's no doubt about that. But do I feel comfortable shorting a chart that looks like this? No, I would feel better to short Stanley Black Decker when it meets resistance at the 20-day moving average in purple as an example. That's worked quite a few times. But yeah, if we go here and look at these other indicators, RSI, we have gone lower. Then again, this also is a level that is rare. Very often this level can form lows. Looking at the daily data points, we see something similar. Yes, there's been some times where we got even more oversold, but looking, big picture, is this a great time to turn bullish and short Stanley Black Decker? Not based on these indicators. There's been some times, but very often it's been a time where some mean reversion comes, which in this case would be to the upside. In this case, I write oversold and horizontal support. I give the bulls a 7. That 7 is, of course, based on the current chart, where we do see that the bears stopped at a key support level. If the bulls are not willing to buy and push this stock higher and we lose this support level, then obviously the technicals would change very substantially. But based on the current here and now setup, this is a 7 to the bulls. Here is the seasonality. Looking to the right here, over the last 5 years in green, 7 years in blue, 10 years in red, leading up until the 1st of November is usually bullish for Stanley Black Decker. To the left, over the last 5 years, from August to November, seasonality is very good. Over the last 10 years, yeah, from September, October, and into November, pretty good seasonality. Big picture, the last 20 years. The coming months are some of the absolute best for this stock. Given that we literally have the best seasonality for this stock right around the corner, I give the bulls a strong 8. Let's look at the fundamentals. SAX has a number 5 strong sell, a D value, degrowth, C momentum, industry rank bottom 13%, tools and related products. Market cap is 12 billion US dollars, but there is a 4% yield. Looking at insider activity, we do see, buy. So throughout the current month, the insiders are buying, and not a lot, looking at the number of shares, but at least they are buying. It's good to see. Ideally, you would see more shares, but yeah. Looking at the consensus estimates, the average price target is 49% above us. Highest is 127% above us. The lowest price target is 14% above us. I give the bulls a 4 here on the fundamentals. Long term, there is a 44% correlation with the S&P 500, 56% with the consumer discretionary ETF, 18% with the consumer staples ETF, then minus 87% with the dollar index. Short term, 72% with S&P 500, 62% with consumer discretionary, and 43% with staples, then minus 94% here with the dollar index. So very negative correlation with the dollar index. So what happens with the dollar index is definitively going to have a bit of an effect on Stanley Black and Decker. So here is the dollar index. It's been on a huge, unprecedented move. Just massive. Looking here at the RSIs, the MACDs, the PPOs, we are at very rare levels. We did see these kinds of extreme levels back here. After this super rally in 2014, 2015, you see that after that, we did have a very erratic, digestion of the move that actually eventually was resolved lower. So there's that. There's no guarantee that the same thing will happen. Looking here at the daily data points, we do see that even during this uptrend, the current readings on the blue PPO, which is the 100-day moving average, also the green 50-day PPO, back here in July we did see a pullback. Back here in May we saw a pullback to the green 50-day moving average. So there are technical reasons here to think that the dollar index is very much due a bit of a pullback. Given that there is a negative correlation between the dollar index and Stanley Black Decker, it means that if the dollar were to weaken, that would, even if it's just like a pullback, it would be bullish for Stanley Black Decker. Yeah. So here we are comparing these two. We have very rare readings on the RSI. We usually do not see Stanley Black Decker underperform the dollar this much. We don't get any seasonality data. So I give a 6 here on relative performance. A key reason for this 6 is that we have seen that the dollar has gone on a huge rally. The previous time we saw something similar, the market took some time to digest the move. If something similar were to happen, given the negative correlation with Stanley Black Decker, it would be bullish for Stanley. So yeah, we end up with a very strong 6.3 here in favor of the bulls. We are oversold and at horizontal support. So the data here is just simply good. Does that mean that it must then go up? No, but it means that there is definitively the expectation that it will go up. When the expectations are high, that is when you can get a lot of bulls pushing it up. But if there is a lot of disappointment, yeah, that's also when the disappointment can also be very high. So when it comes to these kinds of scores, it's a bit messy, because it's the best thing is to have a bit of a Goldilocks thing. And then again, I do want to begin to use more of the range from -9 to +9, because when you use these kinds of scores, there's a tendency to hover a bit too close to the middle numbers. So we have some time left, so let's look at some various stocks. Here is Nvidia. Nvidia, it did have the opportunity to use the 200-week moving average as a support level. We did see that the bulls had a bit of a rally, but then they lost it, so a bit dangerous. We are at some kind of horizontal-ish support level, but it was not good to lose the 200-week moving average. But at least some bulls tried to use it. That is why we went all the way up here to test the 5-week moving average. Let's look at Apple. Apple went all the way up here bullishly to test the green 50-week moving average, but then we went down. So there were quite a few of those moves. Let's look at space. Virgin Galactic Holdings is making a new all-time low. That is bearish, very, very much unfortunate. Long term, I am definitively bullish, but this setup is not really ideal. If we, of course, were to revisit the highs, because we have now fallen down to such a low level, the percentage move up would be even that much bigger, approaching 1,200%. That would be a very nice trip. Let's look a bit at the RSIs. The problem is that we have been lower in the past on the weeklies. On the dailies, here again, looking here at early 2020, late 2021, and also here in mid 2021, during those sell-offs, we did actually go lower before we had that good risk reward entry opportunity based on being oversold. Let's look at the S&P 500. We have just lost the gains that we made. We could of course say that we have a double bottom. Another thing is that the red 200-week moving average is relatively close by. It was extremely important back here in 2018, so definitively something to have on our radar. Looking at the dailies here, we do see that there's some kind of low-ish behavior around here. Okay, it's at least an opportunity for the bulls, but you also have to beg the question, if there are so many bulls out there, why did they freak out at the 200 daily moving average? Why did they do that? There's a saying, the bulls stay above the 200-day moving average, the bears, they stay below. And this behavior is very much bear market behavior, where major support levels are resistance, and we make lower highs and lower lows. The big thing to look at, if we do get a bit of a rally here based on a double bottom, that is what happens with the now blue 100-day moving average. If that were to be a clear resistance level like it was back here, then we would see a deterioration where the 100 days starts to function like the 200-day moving average. And that's something you do see when bear markets go from bad to worse, is that the bulls, they just lose one moving average after the other, and even in more sensitive moving averages become more and more of a problem, so you can't even test the 200 day. you can't even challenge the 100-day, or maybe you can't even challenge the 50-day moving average or the 20 days. So it starts to like be downgraded, which shows that the selling pressure is just very high. Of course, at some point, it's going to be so high that the low will be in, but that is definitively going to take some time. But yeah, we have very clear bear market behavior. That does not mean that there will not be rallies within the bear market. Some of the biggest rallies happen during bear markets. So it's important to have a bit of a balanced portfolio. But nonetheless, what we see on the S&P 500, it's rather problematic.